Silver just hit $71.62, down from $121.62 at its all-time high in January. That is a 40% crash in less than 60 days. And right now, you are being told the bull market is over. I am here to show you exactly why that narrative is wrong, why the current data tells the opposite story, and why the people selling silver at $71 may be handing the opportunity of a decade to the people buying it. Welcome back. If you are new here, this channel exists for one reason: to show you the data behind the headlines before the headlines catch up to the data. Hit subscribe right now, because what I am about to walk you through is not being covered accurately anywhere in mainstream financial media. They are telling you silver is broken. The data says something entirely different. Let me set the scene for you. On March 18th, 2026, the Federal Reserve held its benchmark interest rate at 3.5 to 3.75%. Chair Jerome Powell released a dot plot projecting just one rate cut for the remainder of the year. The 10-year Treasury yield immediately climbed to 4.25%, and within 48 hours, precious metals were in full liquidation. Gold dropped toward $4,600 an ounce. Silver, which is more leveraged to speculative positioning than gold, fell harder, losing more than 10% in a single week, and closing Friday near $71.62. The iShares Silver Trust, the world's largest silver exchange-traded fund, gapped lower at Thursday's open on heavy volume. The headlines arrived immediately. The bull run is over. The smart money is leaving. Silver holders were fooled. I want you to pause on that framing, because I have seen this movie before, and I think you need to really think about when you have seen it too. In 2008, gold had just set a new all-time high above $1,000 an ounce for the first time in history. It happened in March of 2008. Then the financial crisis arrived. Margin calls, forced liquidation. Everything that was not bolted to the floor got sold. Gold fell from that $1,000 high all the way to roughly $750 by October of 2008. That is a 25% crash from an all-time high. The headlines then were identical to the headlines today. The gold bull market is over. Safe havens are not working. The precious metals thesis is broken. By 2011, gold was at $1,900 an ounce. That is what happened after the 25% crash. Now let me tell you what is happening in 2026. The setup is not identical to 2008. In several important ways, it is structurally more serious, and that is why I think this pullback, as brutal as it feels, is actually the confirmation signal that many analysts in this space have been waiting for. Here is what I need you to understand before we go any further. Spot price is not the market for physical silver. Spot price is the price of a paper contract on the COMEX exchange, a futures market where the overwhelming majority of contracts are settled in cash, never in metal. And right now, those two markets, the paper market and the physical market, are telling completely different stories. Let me give you the specific numbers. As of early March 2026, the COMEX registered inventory, that is the silver officially designated as deliverable against futures contracts, stood at approximately 86 million ounces. That is a 64% decline from the 240 million ounces held in April of 2020. Let me say that again. 64% of the deliverable silver that existed in COMEX vaults 4 years ago has left the building. On first notice day for the March 2026 silver contract, delivery notices were issued for 10,526 contracts. That represents approximately 52.63 million ounces of silver, demanding physical delivery, more than 60% of the total registered inventory in a single delivery cycle. The paper-to-physical leverage ratio on COMEX currently sits at 7 times. 7 paper claims for every single ounce of deliverable metal. Now think about what that means. A paper price crash driven by Jerome Powell's dot plot, by margin calls on leveraged futures positions, by speculative accounts closing long trades. does nothing to change those numbers. The metal is still gone, the delivery demand is still there, the paper price went to $71, the physical reality did not change by a single ounce. This is the magic trick, and once you see it, you cannot unsee it. If you are enjoying this breakdown and you want this data delivered to you before the mainstream covers it, drop a like on this video right now. It takes 2 seconds and it tells the algorithm that this content needs to reach more people. Now let us talk about what specifically caused this week's sell-off, because the mechanics matter. According to the Federal Open Market Committee's statement from March 18th, the median projection for the federal funds rate at year-end 2026 moved from 2.9% all the way up to 3.4%. That single revision tells markets the Fed is not planning to rescue them with cheap money in the near term, and that matters for precious metals because of one concept: real interest rates. Real interest rates are what you get when you subtract inflation from the nominal interest rate. When real interest rates are positive, when bonds actually pay you more than inflation takes away, investors are rewarded for holding cash and treasuries. That creates genuine competition for gold and silver, which pay no yield. This is exactly why precious metals entered a bear market in 1980 and did not recover for over 2 decades. From 1980 to 2002, real interest rates were consistently positive. Bonds paid real returns. Gold and silver were dead money. Then something changed. In 2002, real interest rates began a long structural decline, and gold started a bull market that lasted a decade and took gold from $250 to $1,900. That is what real interest rates do to precious metals over time. Full stop. So the critical question for right now is this: are we heading back to a world of sustainably positive real interest rates? Or are we in a temporary moment of hawkish posturing before the Federal Reserve is forced by recession, by a debt crisis, by something to cut rates again? Here is the data you need to answer that question. The United States government is currently paying approximately $1.3 trillion per year in interest on its national debt. $1.3 trillion. That number is larger than the entire defense budget, and it assumes rates stay roughly where they are. Every additional quarter-point rate increase adds tens of billions of dollars to that annual burden. Meanwhile, city economists, as of February 2026, are projecting softer job growth in spring and summer, which would create room for up to 3 rate cuts later this year. The Pentagon has reportedly requested an additional $200 billion in unbudgeted spending from Congress to fund the ongoing conflict with Iran. More deficit spending means more debt issuance. More debt issuance means the Treasury must sell more bonds. More bond supply means prices fall and yields rise, which paradoxically puts even more pressure on the Fed to eventually intervene. Every single time in modern history, 2001, 2008, 2020, when the economy entered recession and the data deteriorated, the Federal Reserve cut rates. Not because they wanted to, because they had no other political option. That pattern has not changed. And when they cut this time, whether it is late 2026, whether it is 2027, precious metals will be positioned to make the move that will make the current correction look like a footnote. Now, I want to address something directly. I know some of you watching this are worried. Silver was at $121 in January. It is now at $71. That is not a small paper loss. I understand. But let me put one piece of data on the screen for you to really absorb. In all of 2025 combined, COMEX delivered 474 million ounces of physical silver. That compares to 203 million ounces delivered in 2024. The delivery volume more than doubled in a single calendar year. Industrial users, solar panel manufacturers, data center builders, electric vehicle producers, defense contractors are not buying futures contracts as a financial trade. They are standing for physical delivery because they need the actual metal to make their actual products. A paper price crash does not change their need for silver. The Silver Institute estimates annual mine production at approximately 830 million ounces against annual demand exceeding 1 billion ounces. That is a structural deficit. It existed before this week's sell-off. It exists after this week's sell-off. Paper markets can suppress price discovery for a period of time. Physical reality always reasserts itself. The question is not if, the question is when. Comment below right now. Drop hold if you are not selling your silver before it reclaims $100. I want to see how many of you are still positioned correctly through this. Let me now walk you through the historical analog one more time because I think it is the most important framework for understanding this moment. In the decade-long gold and silver bull market that ran from 2001 to 2011, there were multiple sharp corrections. 2004 saw a 30% pullback. 2006 saw another significant correction. 2008, as I walked you through, was the most severe, a liquidity-driven crash that took gold down 25% from its highs. Each time, mainstream media declared the bull market dead. Each time, the structural drivers, deficit spending, negative real interest rates, dollar debasement, institutional buying reasserted themselves. We are not in 2011 right now. Based on the cycle analysis, based on the debt trajectory, based on the COMEX delivery data, we are in 2007 or 2008, which means the final leg, the one that took gold from $750 all the way to $1,900, has not happened yet. The equivalent move in this cycle, given gold's starting point and the structural forces at play, is what several analysts at institutions, including UBS, have described in their 2026 outlook as a potential path towards $6,200 for gold. If the gold to silver ratio, currently sitting at approximately 64-1, were to compress even partially toward the historical average, silver at $100 is not a ceiling. It is a floor. This is not financial advice. Every individual must assess their own risk tolerance, time horizon, and financial circumstances. I am sharing what the data shows. Every reference is in the description below. There are three types of people watching this video right now. The first type is scared. They saw $71 silver this week, and they are wondering if they made a mistake. The second type is confused. They cannot reconcile the paper price with the physical market data, the delivery records, the vault drain numbers, the industrial demand trajectory. It does not add up and they do not know what to do. The third type understands exactly what is happening. They know that the paper market and the physical market told two different stories this week. They know that 49 million ounces of physical silver was stood for delivery at COMEX in January alone, 7 times the historical average. They know that the government of the United States has reportedly been buying silver above spot price to rebuild its strategic stockpile. They know that Jerome Powell's dot plot changes futures positioning, but it does not put silver back in the vaults that have been draining for 4 years. The third type is not selling. The third type is buying. Which type are you? If this data changed how you see this week's crash, share this video with someone who is panicking right now. They need to hear this. Hit subscribe for daily analysis that goes deeper than the headlines. Tap the notification bell so you never miss an update. And drop your silver price target for the end of 2026 in the comments below. I want to know where you think this goes when the physical reality finally reasserts itself.